naturally, the scale of the shock that we have faced is completely unprecedented and without equivalent in modern economic times. And the way we have tried to go about the analysis in the commentary, rather than doing the traditional forecasts that we would normally have done, you know, the degree of uncertainty both around the actual development of the disease and its epidemiology, but also the economic fallout that comes with the pandemic and the related restrictions on economic and social life, are such that the best way we feel we can provide some economic insight is to provide a number of scenarios which give a range of potential outcomes and paths for the Irish economy under various different aspects of the disease's epidemiology. In terms of the quarterly itself, you'll see throughout the quarterly there's been quite a considerable amount of analytical work done by both ESRI colleagues and external contributors. And some of those are joining us for the Q&A today, but we've tried to weave in as much analytical insight as we possibly can from the various teams within the ESRI to try and enrich the analytical aspects of the work. So in terms of the scenarios that we deploy in this particular commentary, we've tried to take three particular concepts that are associated with the disease and the fallout from it. One is, which is our baseline scenario, which is a kind of a new normal scenario. So what we're deploying in this particular economic scenario is that there will be a recovery in the economy towards the end of the year. Between now and mid-August, the economy will reopen in line with the government's roadmap. But that for the rest of 2020, there will be ongoing disease suppression mechanisms such as physical distancing or other lighter restrictions that are required which won't allow normal economic activity in a pre-COVID sense to return by the end of 2020. So that's our baseline scenario, and in a sense that's the one we feel is most likely at this given the information at this present time. The second scenario that we deploy is a more benign scenario. So what this assumes is that we will progress through the government lockdown from now until mid-August, but then towards the end of the year, the pandemic will be suppressed to such an extent, this be it through very effective contact tracing or testing or through the deployment of a medical intervention, that we will be able to get back to normal economic activity by the end of the year. The third scenario that we deploy is what we've classed as the second wave. So what we've tried to do in this particular scenario is simulate what would happen if we had to go back to a strict lockdown with very serious measures implemented for the full final quarter of the year. So this kind of takes into account the fact that, look, the disease may re-emerge quite strongly towards the end of the year, and we may need to reintroduce very strict measures that were undertaken at the end of March here in Ireland. Naturally, for each of these scenarios, we've charted out a path for the main expenditure aggregates, in particular investment, consumption, and the trading position, and we've allowed those to differ through their pathway towards the end of the year, and we will talk in a little bit more detail about that. So, in a sense, trying to give a range of estimates from a new normal, which contains ongoing physical distancing, to the much more severe second wave effects of a strict lockdown. Okay, so let me just talk you through some of the findings, the main results. So if we look at our baseline case, we have predicted consumption to fall by about 13%, and we have government spending up by 11%. Naturally, the increase in spending will take place through a number of avenues. Obviously, the income supports and supports for firms have been put in place, but also the increased requirements on expenditure in healthcare will lead to quite a considerable increase in government spending this year. Investment is down very severely in the baseline. It's down by about a third. Investment is one of those expenditure items that's very highly affected by uncertainty. Firms will react very quickly in terms of their capital spending if they can't make predictions about the future. So that's one of the items that's down markedly this year across all of the scenarios, in fact. The global nature of this pandemic means that the export position will be severely hit in all scenarios. And in the base case, we have that down by about 8%. Putting all these together, we see GDP falling by approximately 12% under the base case. If we move across the scenarios and deploy the kind of second wave effects, you can see the severity of that happening towards the end of the year is quite considerable. Consumption would fall by about a fifth, investment would fall by about 2/5, and GDP would be down by a further 5 percentage points. So we would see GDP falling by 17% in the severe second wave case. In the case where we are able to move back to a new normal towards the end of the year, where there's been an effective disease suppression, we would expect GDP to fall by about 9%, with consumption investment down 12 and 18 approximately. I guess one of the points to note there is that, even in the case where the disease is effectively suppressed by the end of the year, the economic shock will be quite sizable. I think that's an important point to make clear. In terms of the labour market, Kieran's going to talk about this in more detail later in the presentation, but in terms of the high-level figures, in our base case, we see the unemployment rate averaging 17% for the year. Naturally, it has shot up as the restrictions kicked in late March, and we've seen the very high levels of income supports and unemployment that has occurred in the economy in April and into May. But averaging across the year, we see the unemployment rate just over 17%. In the severe scenario, we see it at approximately 20%, and in the benign, it'll come back down a little bit to 15%. In terms of the public finances, we put forward figures here for the baseline case, and in that context, we see the overall deficit moving to approximately 9% of GDP this year, given all the supports that have been brought into place and the additional expenditure that's required to both support the economy and to take the public health measures required. And that, in monetary terms, equates to about 30 billion in euros. Okay, so let me just talk a little bit about the consumption and investment channels before I hand over to Kieran. What we've done in this particular commentary for the consumption is to leverage work that we did with our colleagues from the Tax, Welfare and Pensions team as part of the Budget Perspective series that was released earlier this week. What that particular paper did was to chart out a course for private consumption for the rest of the year under very similar scenarios to what we've deployed. And what they did was they used microdata from the Household Budget Survey and mapped in expected changes of consumption under the 3 different scenarios for this particular year, informed by some data that is already out for Ireland and the international literature in this area to produce the consumption forecast. So we have leveraged this work in the commentary for the summer 2020. I guess one of the points to contextualize for consumption is that even to date, while we are early in our understanding of the pandemic, we can see very clearly there has been a marked decline in many of the indicators that give us some real-time information around consumption. For example, retail sales figures for March that the CSO published in April show a very marked decline in particular items. For example, expenditure on bars, textiles and clothing, and the motor trade were down substantially in March. And we have to remember, March wasn't even a month in which the full restrictive measures were in place. So that just shows the scale decline. Naturally, there were some offsetting increases in particular expenditure items as households recalibrated their spending profiles to take account of the new reality. So, for example, more expenditure was undertaken on food and beverages and expenditure on hardware and those type of items. But overall, quite a marked reduction in retail sales expenditure when you compare March to what came before in January and February. When we look at some of the other indicators you'll see outlined in the commentary, consumer sentiment and those type of high frequency indicators that we normally track for household spending, they're all pointing to a very marked and protracted decline in consumption that really hasn't been seen before, even during the financial crisis, in terms of the rapidity of the decline. To maybe just give a little bit of more flavor from the work that we're leveraging, the work that was published under the Budget Perspective series on Monday, what that team did was that they looked across the various spending items and tracked out expenditure across the 3 different scenarios. And what you can see is that in particular items, for example, expenditure on transport, expenditure on food, clothing and footwear, under all of the scenarios, there's a very severe decline, but in particular under the second wave scenario, you can see clothing and footwear expenditure is down by nearly 40% for the year, with expenditure on transport down nearly 50% for the year. So across all the major expenditure items, there's marked declines in consumer expenditure. One of the areas that we've looked at in a little bit more detail in the commentary, thanks to an analytical box that was provided by Professor John Fitzgerald, is the extent to which some of that consumption may actually return as a stimulus once the pandemic phase moderates to a certain extent. And the insight that provides evidence for that is the fact that the fall in consumption to date has been lower than the expected fall in disposable incomes, given the very extensive support measures that have been put in place. And what John Fitzgerald's box looks at is the fact that if incomes don't adjust to the same extent as consumption, well, then the savings rate will increase considerably. And therefore, when we come out of the pandemic phase of the crisis, many households will have accumulated savings that they can then use for expenditure, and this may provide a stimulus to the economic recovery. So that's quite an insightful piece that John Fitzgerald included in this particular commentary. In terms of investment, as I had mentioned before, and firms will take a very will react very quickly in terms of their investment expenditure when uncertainty grows, and it's highly likely that a huge amount of capital expenditure will be postponed or cancelled, given the incredible uncertainty that we're facing at present. You can see the chart here shows the economic sentiment index, which is a good leading indicator for firms' perceptions of the economic outlook. This is published by the European Commission on a monthly basis, and you can see the dramatic decline in the second quarter of 2020. Some work we've done in the commentary shows that this indicator is highly correlated, particularly with expenditure on machinery and equipment, and therefore we've used the correlation between those two to give a prediction for machinery equipment investment, which will fall considerably in the second quarter and throughout the year in that regard. In terms of building and construction expenditure, we see that impacted a little bit less, in particular given the timeframes along the process of committing capital for building. And so we don't see as marked a fall occurring in this particular investment area relative to machinery and equipment. However, it won't be completely insulated, and there will be a marked fall in this. Particular construction firms and building firms will have to try and find ways to adjust to the distancing restrictions and any of the other measures that continue to be in place, which will make it more difficult to maintain productivity and output in the investment area. So in general, with investment, we see the base case falling by a third, In the benign scenario, investment is down by about a fifth. And then in the severe case, it's down by about 2/5, which is a very, very severe reduction. With that, I'll hand over to Kieran to talk through trade, public finances, and the labour market.
Great. So do you want to unshare your great stuff? And I'll just share my screen here. Okay, let me just go back a bit. Okay, so thanks very much, Conor. And just to follow up then on the trade situation. So obviously, we see, because obviously the pandemic crisis is something which is impacted globally. It has a significant and substantial impact on our own trade performance, and you can see the summary of our results under the 3 different scenarios that we expect in terms of the baseline case, the benign, and the severe. And obviously, both exports and imports are hit. Exports because obviously foreign demand for goods and services is likely to fall. And imports because obviously there's been a significant and substantial drop in consumption and as well in investment, which has an impact on import levels into the economy. What I'm going to do is move on to a box which I think is very informative. It's work that's done by our colleague Adele Bergen and Albion Garcia Rodriguez. And what that box does is it places and gives a little bit more in-depth analysis of the trade performance. So it uses Cosmo, which is our structural model, and crucially it links Cosmo in with NIGEM, which is an international network of models, macroeconometric models that are maintained and run by the National Institute in London. And so that allows us essentially to if you like, map international shocks through down into the domestic economy. And obviously that is crucial as far as trying to evaluate what the overall impact of COVID-19 is on the domestic economy. In this work, 3 scenarios again are used: a baseline scenario, a benign, and a severe. These are not exactly the same as the ones that we have in the rest of the commentary, because obviously this is looking at the shocks from an international perspective, whereas I suppose the other shocks are looking, or the other scenarios are looking more from the domestic point of view. But nonetheless, they're very similar, I suppose, in terms of the relativities, in terms of the magnitude of the impact. So under the baseline scenario that Albion and Adele run, there's obviously reduced spending internationally. And I think the assumption is that the crisis will have a maximum impact in Q2 of the present year, and that it will essentially, the most severe of the impact will be through the first 3 quarters of the year. And then as you move into the 4th quarter of the year, you'll expect to see a recovery in the global economy, and hence a recovery in terms of demand for goods and services, for Irish goods and services. Overall, that will mean that for the first 2 quarters of the year, I think there's a 20% reduction in exports, in the demand for Irish exports. The benign scenario draws on the, I suppose, on the fact that a lot of Irish exports, or certainly, a certain degree of Irish exports, are in areas that may not be as sensitive to the downturn, international downturn, as others. In particular, I suppose, if you look at the composition more recently in terms of the contribution for pharmaceutical products, medical devices, those are less likely to be impacted by the global downturn, and consequently, under a benign scenario, I suppose, given the robust contribution even into Q1 of the present year, especially from the pharmaceutical sector, the expectation under that scenario is that would continue true for the rest of the year, and so therefore there wouldn't be as big an impact. The severe scenario, the 3rd scenario, and obviously the one with the biggest impact, in that case, I think the auditors are essentially looking at the impact of a scenario which is very similar to the one run by the ECB. In that case, there's more longer term impacts and ill effects, if you like, of COVID-19 on issues around global supply chains. Ultimately, countries becoming even, becoming more self-reliant, and hence, if you like, a deterioration in globalization. And that obviously would be a negative factor as far as the Irish economy is concerned. So I think the box gives a very nice flavor as to the potential impacts of COVID-19 on the Irish economy from an international perspective. In terms of our labour market results, again, obviously, the effects are very, very substantial and very, very significant, as we pointed out in the last commentary. I suppose the characteristic of the labour shock is both the scale of it, but also the speed and rapidity with which we've gone from a situation where unemployment was in and around 4.5% in February. And if you look at the returns in April, it had jumped to 28%. And that is not including, for instance, those on the wage subsidy scheme, in which case the figure could be even higher. So ultimately, you're looking at a situation where almost 700,000 people are receiving unemployment benefits in the state. And if you look at the live register data for April, you have 816,000 on the live register availing of the COVID payment. And overall, when you factor in the wage subsidy scheme, you're talking somewhere in the region of 1.2 million people on the live register, which is quite stark and quite staggering in terms of from a historical context. The next slide essentially looks at that. It just looks at unemployment going back to 1973. And what I've done is we've simply isolated, if you like, the previous periods where unemployment reached a very high level. So obviously in the early 1980s, after the oil shocks of the 70s, and then in the period after 2007 when you had the financial crisis. And so what we're doing is just there in between the two black bars is we're just noting the period or time that it took to go from the trough, if you like, to the peak. So back in the early 80s, it took 21 quarters to go from the trough to the peak unemployment rate of around 16%. And equally, if you look at the financial crisis, you're talking about it taking 12 quarters to go from the trough of just under whatever, I think was around 5% unemployment up to a high of 16% by 2012. So that puts the present scale. And you can see then at the far end of the graph, the very rapid increase in unemployment in the present context, literally happening in the space of a number of weeks. Our colleague again, Barra Roundtree, has done some very interesting analysis in a box looking at the nature of the distribution of the losses in terms of who is more likely to be in receipt of the pandemic payments, both in terms of their age, in terms of their gender, and in terms of from a regional perspective. So if you look at the table there, you'll see in column 2, the total numbers of people in the different categories as of 2019 Q4. So if you like, the last period of historical data before the onset of the COVID crisis. And there in column 1, you can see the people who are claiming the pandemic payment as of the 10th of May. And then in the third column, we simply divide one by another, which gives you the percentage in terms of the people who are now claiming on a relative basis. So as you can see from the column, that claims are higher on a marginal basis by men versus women at almost 28% compared to 24%. Claims are highest in the border region and lowest in Dublin, an interesting breakdown. And also another point which Barra notes in the box, which I think is interesting, is the increase in the non-pandemic welfare payments. So you can see that those numbers have risen by 13 and 19,000 respectively between February and April. So again, I think a very useful contribution in terms of a breakdown, granular breakdown on the on the labour market implications. And as I said, given the sheer scale and rapidity of the shock, I think it's very interesting to have that kind of breakdown in the commentary. Public finances, again, the results are quite stark under our scenarios. So overall, we believe under the baseline case that the deficit will reach 9% of GDP for the present year. On a monetary basis, that's around 28 billion, which would increase our debt to GDP to around 66%, up from it had fallen obviously on a fairly significant basis over the last number of years. It's fair to say that the figure could be higher than that. For instance, we've made certain assumptions around the pandemic payment. We assume that the pandemic, following government policy, we basically assume that the pandemic payments will stop at the end of June. So obviously, if the payments were to be continued after June, it would lead to a higher level of expenditure in terms of the overall economy, and consequently a higher deficit by the end of the year. Other reasons why our deficit figures are a little bit different, or more significant, if you like, than what was put out in the SPU. Essentially, we're factoring in, higher reductions or larger reductions in some of the exchequer receipts in terms of the income tax categories. And so, for instance, in a box, we look at the issue again in more detail, trying to factor or estimate the sensitivity of receipts to underlying economic activity. And by that, we're just drawing on some previous work that has been done in the Institute over the years, just to, if you like, to draw on the elasticities or the estimates, the sensitivity of taxation receipts to underlying economic activity, in order to get a handle on how we think receipts will fall in light of the present crisis. I think one of the issues that's addressed in the box, one of the big issues is the potential impact on corporation taxes. That's a real unknown. You know, obviously there'll be a very adverse impact on areas like VAT, income tax, PRSI receipts, but on corporation taxes, we really don't know what the full scale of the impact will be. Corporation taxes did fall very substantially after the financial crisis, I think by 40% over a 2-year period. So it really will be a big, the big question mark will be, I think, around how well corporation tax receipts hold up in the present crisis. And we'll really have to wait until the June figures come in to get some preliminary estimate as to how well or not those figures are holding up. They had been quite strong for the first 3 months of the year, and particularly in February, but that's not the typical, that's not when most of the receipts come in. But nonetheless, as I said, it's something to certainly to look out for over the next month or so. A final box then, we look at, again, drawing on previous work that I was involved in with 2 colleagues from the central bank, Peter Dunn and David Cronin, where we looked at the implications, where we modeled essentially the bond spread, the Irish bond spread. This was published in the Economic and Social Review in the last year, and it basically modeled the spread, which is the Irish bond yield over the EONA rate, the kind of the risk-free rate. And it modeled it in the context of things like debt to GDP, income levels in the economy, and the banking sector variable. And then we use that model in the box just to forecast, if you like, the implications for the bond spread in Q2 of this year. So we essentially have actual data for Q1. The spread was around 0.4%. And then we simulated what the impact on the spread would be in light of the deterioration, particularly in the debt to GDP ratio, just for that quarter. So the debt to GDP increased obviously between Q1 and Q2, and we modeled the impact of that. And our estimate suggests that the spread would go from 0.4% up to just under 1.2% in Q2, which would essentially bring it back up, if you look at the graph there, to where it was circa 2018. Now, it has to be said that that modeling exercise is done in the absence of any modeling in any policy response. So clearly, the policy response of the monetary authorities at a European level, the ECB in particular, is crucial in terms of how bond spreads evolve in the coming months and years. And so this exercise is in the absence of any response, if you like. It's just purely looking at what the model suggests would happen to bond spreads in light of the deteriorating fiscal parameters and backing out the impact from that. But clearly, if the authorities do respond, then that would have would mitigate, if you like, the impact on the bond spread of the deteriorating conditions. Just moving on then to the assessment, the overall kind of analysis. I think if you look at the commentary, you'll see that we make a strong argument so far. If you take the nature of the support, if you like, the policy response has been detailed and specific. It's looked at supporting household incomes. It's looked at trying to support firms. That was the correct approach, particularly in the lockdown period when people were unable, if you like, to go out and consume. However, as the economy opens up over the coming weeks and months, I think there is an argument now for a kind of a more broad-based fiscal stimulus to try and kickstart activity in the economy for the rest of the year and into next year. There's a number of different approaches that could be taken in that regard. If you go back and look at the box that our colleague John Fitzgerald did, he points to the fact that there could well be a significant build-up or there will be a significant build-up in personal savings. That could come on stream in terms of higher consumption levels over the next couple of years when economic conditions stabilize. So that will be a stimulus at some stage. But in the shorter term, we think that a stimulus that concentrates on investment issues and significant increases in investment is probably the most appropriate response. Those investment projects would look at ones which would have environmental and sustainability criteria. I think that's important that we try and maintain and try and reach our environmental targets at this present point in time, notwithstanding the duress that is there. But also we think the housing area is a crucial area which could be addressed. Social and affordable housing, as we've noted on many occasions in the Institute, is an area where there's been a substantial imbalance between supply and demand over the last number of years. We think that addressing that through increasing the commitments made in terms of social and affordable housing in the short to medium term would meet two criteria. It would, on the one hand, help to stimulate economic activity, but on the other hand, it would meet a key kind of policy issue and social and economic policy issue in the economy at this point in time. We note as well, in terms of the supports that provided for SMEs and enterprises generally, it's a very difficult issue. Obviously, it's been a little bit easier to provide support to households. That's more straightforward. Providing support for firms is more difficult on the basis that we don't want firms to come out of this with higher levels of debt or substantially higher levels of debt that will, if you like, reduce their ability to survive in the post-COVID world. So therefore, we talk about the issue of expanding grants and providing cash injections to firms as a way of supporting them. I think underpinning the domestic response clearly is the position taken by European institutions. We pointed this out in our last commentary, and the point is again very much made in the present one. We need specific and clear guidance from European institutions as far as the kind of fiscal strategies that the domestic or that the individual member states can follow. I think that's very, very important going forward, so that countries have a good idea as to what is feasible from a fiscal perspective in the medium term. And that will provide a degree of clarity. Obviously, there have been developments, and we, applaud the recent debt mutualization agreement secured last week, and the proposed 500 billion recovery fund is very much a positive step forward, and it is an important step to acknowledge the principle that has been essentially conceded or agreed to by both the German and French authorities. But I think more will be required, and obviously there'll be announcements today, I think, from the Commission in terms of other supports. We also note, just finally, the possibility of an increase in mortgage arrears. We think, and I think particularly if the income supports are tapered off, and if the payment breaks expire, there is a risk of an increase in mortgage arrears in that context. And ultimately, whilst not maybe in the short term, but ultimately that can lead to financial stability concerns if you have a very sustained and significant increase in mortgage arrears. And so that's something which we note as well in the assessment. So with that, that's the conclusion of the presentation.